describe managerial accounting solution, explain the business value around managerial accounting and the different components, some of the business modeling that's possible, and some implementation considerations. So we'll start with receipt accounting. Receipt accounting is the application that performs the accrual accounting for the different types of receipts. This includes purchase order receipts of services, supplies, project materials, inventory, and inventory transfers. Key accounting policies and how you set them up, whether to accrue at receipt or not, will drive some of the functionality. So accrue at receipt in the U.S., you're under the generally accepted accounting principles, a material that you bring in, put in inventory, count as an asset, you're going to accrue at receipt. You can also bring expense items and other things for services where you do not accrue them at receipt, but do the accrual at the end of the month. And hopefully the invoice comes in before the end of the month and you can clear it out of there. But receipt accounting can be implemented separately and independently of Oracle cost management. So if you don't have to worry about managing inventory, you're just doing services or something like that and expense items, good to go. So here's an example of the flow. So we have purchase order receipts. Purchase order has the cost information on it from the price. And when you bring it in, you have any overheads associated to it. Great, it'll pick those up. Receipt accounting takes that information, figures out the accrual, any adjustments. That information gets picked up through the distributions. That creates all of the debits and credits. And then that information gets passed along to subledger accounting, apply your rules, and then post it to the GL. On your purchase order at the line schedules level, there's the itty bitty checkbox that says accrue at receipt. For inventory items, that's going to be picked up from the item master, which is product information management or product hub, depending on what you have labeled your application, product management, whatever it is, the item definition will show this is accrue at receipt. If it's not, then generally it's going to be an expense item and you'll pick it up at the end of the period. Some of the business advantages: it's easier to manage, fewer tasks and receipt accounting, less reconciliation when you do the accrue at receipt. Some of the disadvantages: the accounting may not be timely, but is accurate by the end of the month. So you can choose whether if you want to accrue at receipt or not. So that's some of the advantages of the not. And then if you accrue at receipt, you have more timely accrual accounting, but there's more things to do in receipt accounting, more accounting and reconciliation. If you've never seen it in the app, let's go take a peek. So I'm in supply chain execution, receipt accounting. We pop in here, we can see all the tasks. Notice down here at the bottom, landed cost. So landed cost is part of receipt accounting. And here we've got some unmatched. So if I click on that, it'll actually take me in to see. Now remember, this is a demo instance, so don't worry too much about the dates, but it does show you the information. Down below, you can see the details of the different lines. So as I click on the next line, it'll update the info there. Also, these have front sides and back sides. So exceptions, if I hit that, I can see, if I want to just see my exceptions in the US, I can click on that. It'll link me over to my exceptions. And then I can click on the line and it'll show me the details down below. Okay, let's go back to the slides. So next up, a little bit on standard cost planning. Standard cost planning provides you the ability to manage the cost information on your purchased items and your manufactured items. So you can figure out what your costing is, define all your cost elements, cost your items, apply any overheads. You have the ability to go in and do what ifs. So we went through big inflationary period recently based on the crazy stuff that happened in the world and bad monetary policies, in my opinion. Anyway, so in a lot of cases, we had to figure out what's that going to look like? How's it going to affect my bottom line? I know that commodity prices are going up on certain things. And then most recently, things have kind of settled down. Some areas, prices have come down, but not everything. So you can go back and walk through the process of doing that future part of it. Also with your manufacturing items, based on the work definition has the item structure or bill of material and all of the steps. You can roll that up so you get a pretty good idea of what your cost of building something is. You can apply overheads to not only the material, but resources and work centers. So for a particular machine, if you need to charge a certain rate, and then any overheads for maintenance or maybe insurance, utilities. You've got the ability to do that, define all of your expense overheads, and manage your absorption analysis. You can enable the audit trail, and you can track what's going on, and you can calculate costs for fixed and variable costs. And anytime you have a variance, you can track that and track it back to actually what caused it and figure out, do we have an issue? Is it a one-off? If it's consistently under or over, then maybe we need to re-roll our plan, our cost plan. So here is a depiction of what I was just talking about. So manufacturing work definition has the operations, the materials, resource time. What is the output? Do you do it in a batch size, yay or nay? What is that? Any fixed and variable costs associated to it. And then that information gets rolled into the cost planning scenario based on the information it has. It will either pick up the item cost, or you can estimate the item cost or purchased items. Again, it'll pull in the resource cost information, overhead, and then it will give you the updated information that you can either use, publish out, or maybe go back in and make changes. But it does give a cost accountant the ability to create records for any material estimates, again, the resource rates, overhead rates, and the scenario will take all those estimates and generate the cost update information, the rolled up cost. You can plan, contingency plan, look at alternates. You have alternate paths through the manufacturing area. And you could even look up, does it make more sense for us to do it in-house, send it out? And then after you're satisfied with the results, publish the information. You can put a date as of first of the month. This is what the new cost information is going to be, and you're off to the races. Next up is a little more on cost accounting, a little more details. So cost accounting provides us a lot of flexibility and functionality within the system. When we look at costing methods, you can do first in, first out, or actual. You can do perpetual average, frozen cost, periodic cost. The different costing methods allow you to get granular with the information, so you can go all the way down to a very low level of detail. In the manufacturing area, you can run things on standard cost, which talked previously. You can use perpetual average. You can use the actual, so whatever is charged, we're going to update the cost based on that. You can do layered costing. So a lot of flexibility. If you do a lot of engineer to order items, then you use the ability to look at what that particular item was when you built it. And again, you can get as granular as pretty much you need. Cost elements to capture material cost to whatever your heart desires. I worked with a company that had 13 cost elements. They were bringing stuff in from overseas and they had parsed things up. Pretty low level detail. So item, lot, serial number, grade. You've got a lot of options on your levels of detail. And you have the ability to cost and track the actual cost against your supplies. You can do internal profit if you're sending material between organizations. So if you have something in org A, mark it up for $1 when it goes to B. So now over in B, it's going to be tracked over there, but there's $1 of profit when they do the material. This can be especially useful if you're using actual cost method across your supply chain. It allows you to understand the true margins of your product. For example, if an item is sold for $25 and you know the cost at the enterprise level is $10, the gross margin is going to be $15, and org A receives an extra $1 of that value add, their margin, and org B may receive the $14 as their portion of the profit. So it gives you the flexibility to do a lot of different things in your supply chain. You can also track and dual units of measure. So if you're tracking dual units of measure, maybe eaches and weight, you can do that as well. System supports multiple books. So you're generally going to have the books, probably what you're going to report to the primary ledger, and you do your reporting against at the corporate level. And you may have a secondary book where you want to strip out some of the G&A so you can actually see what's happening on the shop floor, and you can have an idea of the actual cost without all the overhead from the other part of the business. And you can leverage the rapid implementation, and that allows you to take some predefined information and quickly spin up additional cost orgs. So you have consistency across the orgs, and it'll speed the process up for you. Here's kind of the big picture of some of the inputs. So we have information coming in from shipping, receiving, inventory transactions, material going out to the shop floor or issued to maintenance. If we buy things, they come in the back door, we need to pay for them. As we build, pick, pack, and ship, We want to get paid for what we've sent out the back door. Some supply chain financial orchestration will help with inter-business unit transfers. So if you're global, you're doing things over in Europe or going across borders, it gives the ability to manage those payables and receivables. You have project costing, so you can see all of the materials and resources that are being charged to a project. You can track that, post that back to the project in PPM. And of course, there's shared information with pricing and planning as well. So supply chain orchestration, as mentioned, helps manage material going across borders, changing ownership between your organizations, gives you the ability to change the ownership independently of the physical movement of the material. So you can track that, make sure that everybody's getting their piece of the pie as it moves across borders. You can configure the definition cost-based. You can make sure that all the documentation is set up, your transfer rules are in place, make sure that you're compliant with all the legal and internal requirements and moving things across borders, and you can monitor the process. Here's an example of financial orchestration with global purchasing. So you can manage the purchasing. You can have global procurement, purchasing affiliates, have material delivered to wherever it needs to be. You can do the internal transfers, material going from a manufacturing plant out to a point of sale, internal dropship. So there's kind of a pass-through where we deliver directly to the customer, but there could be local sales affiliates that are doing the sales and managing that part of it for the customer. And then there's the good old straight dropship where we have somebody else ship directly to our customer based on, hey, we got an order, kick off the PO, and have them dropship right to our customer. As we mentioned, dual unit of measure, you can have pricing transfer based on the whatever makes sense for your units of measure. So financial orchestration can generate intercompany invoices in an alternate unit of measure as opposed to the transactional unit of measure. The pricing unit of measure is defined at the item attribute level and it indicates the transfer price unit of measure for intercompany transactions. So you've got the ability to manage and track that. If you've never seen supply chain orchestration, let's pop into the app. Back-end supply chain execution. And we want financial orchestration. So in here, we've got shipments, internal transfers, errors, exceptions. Here's a list of things going on. If we clicked on shipments, here's a list of shipments in progress. If I click on the shipment, I can expand the details down below and we can see what's going on for that particular shipment. We can see the sales information, the sales order, and we have some down here that have little error messages. We can see it looks like there's a unit of measure problem. And we can see the source info, event number, and then the sales order info. A lot of good information available in supply chain orchestration. Again, you can go, if there's a problem child, you can go look at the problem child, warnings, etc. Back to the slides. Landed cost. If you're in one of those businesses that has material moving across multiple time zones and multiple borders, landed cost gives you the ability to capture all the costs associated to getting something in your back door and on the shelf. So there's kind of a depiction on the PO, it's $100, but when it gets to on the truck, the port, carried across the port, duties, broker fees, delivered to, in this case, Kansas City, there's another $40 worth of accumulative cost to get this landed on our desk or landed on our dock and into stock. I always used to contend that it's not the price, it's the cost. If you have a great supplier and no hassles, sometimes it's better to pay a little bit more for an item. But again, that was my personal experience. So it'll help you maximize your profit because you can see what's going on. You have the ability to capture everything, anything that shows up in the invoice. You have better visibility and it will help you with your compliance, especially if you do something consistently. So it is a very helpful tool. Here's kind of a picture of where things come from. So you have the information off of the PO purchasing. You have the information from receipt accounting as it's coming in the back door. You can match the receipt. Any of the taxes, you can allocate the charges from the invoice. You can just post them all, or you can choose how you want to do the allocations for landed cost. I don't know if you noticed, let me go back to receipt accounting real quick. So if we click on receipt accounting and in the task area, we're in the drop down, here's the landed cost setup. So you're going to find a template to help speed up the process. So this is what normally happens. You can use the template to capture that. Then you can manage the invoice information, analyze your costing, check for variances. This is a pretty high overview of things. You can actually go and take the cost class and we break down all this stuff to the detail level. Okay, back to the slides. Let's talk a little bit about some of the analysis. So within cost accounting, you've got the ability to run a myriad of reports, plus you can create your own. Some of the standard ones, you can see the inventory valuation, WIP valuation, that's work in process. In transit, if you're using layered cost, you can see the layered cost. You can manage your transactions, transfer them over from inventory and manufacturing and see the details. All of your cost variances, if you're using standard cost, you can manage the revenue and cost of goods sold. Batching, if you're not familiar with that, you can decide at what point you want to recognize the revenue. You can do it when you ship it. You can do it when you create the invoice. You can do it when the customer accepts it. And then there's one other one. Don't remember off the top of my head. You got the tools and the ability to manage that, plus your gross margins. Plus, if you don't like the seeded ones, you can leverage Oracle Transactional Business Intelligence, or OTBI, and you can go into the subject areas and create a report. You can dump that on into an Excel spreadsheet if you want to. You can also take the seeded reports, copy them over, and make changes to match your business needs. And lastly, organization hierarchy. So most of what I've been talking about through all these different lessons has been at the org level. And this kind of adds another layer of cost org, and those roll up to the business units and profit centers, which report to the ledgers, which are managed by the legal entity. A legal entity can have one or more profit center business unit associated to them. The legal entity also uses at least one or more ledgers, and you have which is generally if you have at least one, that's going to be your primary ledger, and that's the one you're going to do your reporting against. Receipt accounting posts to the primary ledger. Cost management pushes that through. SLA, you can have multiple books. You can also do shared services. So if you want purchasing payables to manage multiple locations, you can do that. And again, the cost org, every inventory org is associated to a cost org. A cost org can have multiple inventory orgs associated to that if you just want to manage the cost information one place, shared across multiple inventory orgs. And then you can set up your transfer pricing, or you can just directly send it across to cost. Again, depends on what makes good business sense. The nice thing is you can automate a lot of tasks, especially when it comes to month end. You can also let the system close things out in receipt accounting. If it's within certain parameters, I want you to close the PO line, close the invoice, just we're done with it. You can leverage your business flows in the system. You can enable them in the system and set them up. You can do your financial reporting, make sure that you're compliant. Cross borders, want to make sure that we're not breaking any of those rules. And you can capture all of your cost information for your items.